Hello everybody. So a bit of housekeeping news, in fact very exciting news. I launched aNewFN yesterday and it's in soft alpha launch. So anybody that has registered to be able to use the site has been allowed in. Now, as you're in a select group of people, you can go to aNewFN and you can register or put your name down on the wait list, but go ahead and register and go in and have a look of what I've been up to over the last few months. Now, it's very much UK centric at the moment, but it will have US price feeds in there in due course. So go have a look, see where we're coming from, where I'm coming from. And please email me if you've got any ideas, because we're going to be building this site on the ideas of users, plus mine, of course, and plus the teams. But really, we are there for the community, not the other way around. So please check it out and feedback. Now, if you've seen my earlier videos, you'll note that I've been raving about Intel for some time, and I started raving about them around $20 a share. They're now 37. So, and that's, well, let me start again on that. And that's really not over a long period of time, as far as these videos are concerned. But I started to write about them back at the beginning of the year because it was obvious to me that Intel had the bulk of onshore US and European fabs, and while they were looked down upon by everybody, and while everybody was saying they're not such a great company, they had the only solution to America onshoring chip manufacture in the short and even the medium term, because fabs cost fortunes and take years to build, and Intel are the big footprint when it comes to fabs in the US and in Europe. And it's no good having a fab in China, is it? Or for that matter, Taiwan, is it? Or even Singapore, for that matter, if you're facing off against China. So with the Trump versus China theme, Intel's the only game in town for chips, and chips are the only game in town for any sort of dominance. And AI is the big, big thing, and there's no second place in AI. And if you don't make the chips onshore, you're going to lose, aren't you? So the only way is to have fabs onshore, and the only fabs at scale are Intel. And although they're a little bit behind the competition as far as making chips at the small nanoscale, they're very close and they're catching up fast. So the idea was they would get into fashion because it's the only game in town for onshore fabs. And lo and behold, the American government comes in and says, right, here's some money, we want 10% of you, and get on with it. And ringing up people like Nvidia, no doubt, and saying, do a deal with them, will you? Oh, Apple, yeah, do a deal with them, will you? Oh, XYZ company, do a deal with Intel. We need to get these guys off the starting blocks. We need to get geared up for onshore chips. So hence, as soon as Intel and the US government got all huggy, the share price has exploded. It's at $37.30. Which I think I'm sitting on something like 70 or 80% profit. Now, people keep asking me about, when to get in and when to get out. And that's market timing. That's extremely difficult. But when you are sat on a rocket, like Intel, when do you get off? Do you hold forever? Do you wait for 10 times sales? Do you wait for sales to double? I mean, personally, I think the next stop is 4 times sales, which will put it in the sort of $50 to $60 range. But I know a lot of people, particularly in the US, believe in buying and holding forever. And that turns out to be a pretty good strategy. So if you're a buy and holder and buy the dipper, then you've got no worries. You'll just sit there and watch the share price and hopefully watch it go to the moon and not lose a night of sleep. Now, if you're a market timer, that's a very different world, and it's a much harder world than just buying and holding. And I'm a market timer, and for my sins anyway. So this is what I will do with Intel. Now, I like to get out and take my profits when they're fat. And I used to take them always automatically at 30%, because that was what Benjamin Graham said you should do with this sort of situation. Well, I learned over the years to hold on, because these things can run and run and run and run and run. Now, this is how I would hold on in this situation, and probably how I will be holding on if I don't go, I've got a lovely profit, bye, at $60 or $50 or whatever. I will be drawing a trend line underneath the share price, like this. And when it stops going up that trend line and starts to make a sideways pattern, I will draw a line like this. And if it goes much below that line, I will be thinking about getting out. Now, the theory behind this is as follows. You have a share and it's in equilibrium as far as the world's concerned. It could be sentiment, it could be fundamentals, who knows what's causing it, but it's at equilibrium and it's going sideways, as you could see when it was down at 20. So it goes to 22, it comes back to 19, it goes to 21, etc., etc. What you're looking for is a breakout from that equilibrium, because when something happens to shift the equilibrium, you're going to get a repricing. And when it reprices, it's just going to go, or it could go, of course. Yeah, it goes bang. And then it hits another equilibrium point. And that's where the market players go, oh, maybe I should buy. Oh, maybe I should sell. I don't know. Sell a bit, buy a bit, sell a bit, buy a bit. Or, oh, I'm waiting. Oh, this has been good. And I think this is going to happen next. But I'm not allowed to trade because I'm inside. Ah, the news is out. Bang, I'm in. So you have a new equilibrium, which is in a range, and that range is the range of uncertainty. So the tighter that range is, the more certain the market is. And if it's gone up, you can imagine that it's a high probability that it's going to go up further, because the market is pretty comfortable with this point, and it's pretty comfortable that nothing bad's going to happen. Okay, so you draw a line underneath that, and you say, if it goes through, something's changed. You know, if it breaks on down, something that I'm not a party to has happened, I'm out. Okay, but what is likely to happen is something else will occur. So maybe they're coming out with a new chip and it's coming out on, you know, October the 1st, but they're not sure because it's been promised by Friday and maybe it's not going to happen. So everyone's sat there waiting, and then October the 1st happens, bang, there it is, up it reprices again. So up it goes. So you draw another line and it stops, and then it starts to go sideways again. It's got a new equilibrium. So you follow these equilibriums and the repricings all the way up until you go, I've had enough, or I think something bad's happened, or in my mind, we're in a new reality, or in my mind, I can't sleep at night because I made too much money, or in my mind, I'm scared about the downside. Whatever reason to get out, you get out, because there's always another bus coming along. It's not the only share. Of course, you can look at Nvidia and say, oh, look at that. If only I bought it at nuppence and now it's a bazillion, I would have made, you know, generational wealth. You could look at the same with Apple, but generally those stocks are lottery tickets. And if you can spot them and you're sure that's what they are, then yeah, hold forever. I remember I was in a bar in New York and a young lady was saying to her advisor, oh, Apple has gone up a lot. I don't know what to do. What should I do? What should I do? And I was sat there thinking, you should sell, you should sell. And of course it went up about 30 times after that. So market timing is a very, very difficult thing. And I hope she held and hope she still holds. But those sort of situations are uncommon. And if you're sure you've got one, keep it. And if you're not sure you've got one, then you have to look for the signals of when to leave or what the situation is. And this is a good way of doing it. So you follow the trend, you follow the equilibrium, and when it breaks out, you make your decision. I mean, if you are a trader, if it breaks on up, you buy more. I would never do that. I've done it very rarely, but I would never do that. I just buy my position and just hold and let it run. But if you are really risk hungry, when it breaks up, you buy more. So, you know, that's the way that the people with more nerve than I have do it. But that's the way to trade this sort of rocket. And I hope you enjoyed this little run around how to handle technicals when you've got a moonshot stock. And there'll be more videos like this coming up soon. Thank you very much for watching. Please subscribe and like, because that really does help me. And please pop on into aNewFN, link below, and check it out and tell me what you think. See you soon. Bye now.